In this video, I will go over the basics of stocks and indexes, so you'll be able to better understand when you look at the stock market. The first thing I need to answer is, what are stocks? Stocks refer to the ownership certificates of companies. A more precise term you will generally hear is shares, which refer to an ownership of a particular company. When you purchase a share, you own a portion of the company. Say the share has 100 outstanding shares, and you purchase one share. You own 1% of the company and have the rights associated with that. While it is possible to own a stake in any company, only corporations that are publicly traded can really purchase shares of. There are multiple types of shares one can own. If it is preferred shares, different classes of shares, and common shares. But we will be only focusing on common shares as they are the most common. Owning common shares of companies generally give you these rights: voting power, ownership, the transfer of ownership, dividends, the right to inspect corporate documents, and the right to sue for wrongful acts. Here's an example of a company that one could buy shares of. Apple is the largest publicly traded US company. Each company will have its own stock ticker. Apple's is AAPL. Every publicly traded company will have one, and is essentially the name that they use to be traded on the stock market with. If I type in the search bar GOOG, it'll bring up Alphabet Inc., the parent company to Google. Now this is the share price, $120.96. It is determined by the last sale purchase price of the share. How does one buy and sell a share? The buyer makes a bid for shares at a certain price, and the seller makes an ask for shares to sell at a certain price. Now, if the buyer's bids are at a level of the ask, then the purchase and sale will happen. There is more nuance to this, but the key takeaway I want to stress is that the price is by nature is historical, and as such, depending on the number of shares you want to buy or sell, you most likely won't be able to get that exact price. Now these numbers beside the price refer to the daily gain and loss of a share. An important number to understand the shares of a company is the market cap. It refers to the total equity value of a company and is calculated by multiplying the share price by the total number of shares outstanding. As you can see here, Apple has a market cap over just over 2 trillion. To find out how many shares are outstanding, if you go over to the statistics tabs, you will see that the shares outstanding are 17.1 billion. Probably the most important and easiest metrics to look and consider are the dividend yield and the PE ratio. It says here that Apple has a dividend yield of 0.68%, meaning that you will earn a return of 0.68% from dividends, earnings that the company pays out to shareholders over the year. The PE ratio refers to the share price divided by the earnings per share. This is generally referred to as a price multiple, as it allows you to see how cheap the stock is. Companies with lower PE ratios are generally seen as a cheaper investment. When people talk about stocks being up or down, they are generally referring to what is known as an index. The most common indexes are the S&P 500, the Dow Jones Industrial Average, more commonly known as the Dow, and the NASDAQ. But what is an index, you might ask? An index is the combination of multiple public company shares as to represent the movement of shares in a particular area. You can find an index that tracks practically every area of the market, for example, by sector, country, size, and industry, etc. The most common and best representation of the market in an index is the S&P 500. It is an index that is comprised of the 500 largest US companies by market cap. If you want to follow where the market is going in the United States, then the S&P 500 is your best bet. If you want a similar index for other countries, then I would suggest the S&P TSX Composite for Canada, the FTSE 100 for Europe, and the NIKKIE 225 for Asia. Another popular index is the NASDAQ, which tracks companies listed on the NASDAQ exchange. Now, this doesn't give you an accurate representation of the total market because it doesn't include companies that are listed on other exchanges like the New York Stock Exchange. It is generally seen as a tech-focused index, as most of the big tech companies in the United States are listed on it. The Russell 2000 is much like the S&P 500, but unlike its counterpart, it tracks 2,000 of the smallest market cap companies. Now you might be asking, is it possible to purchase a share in the S&P 500 or other indexes? And the answer is no. But you are able to invest in electronically traded funds, known as ETFs, that mirror the index. For example, here I have pulled up the SPDR S&P 500 ETF Trust that mirrors the S&P 500. This also isn't the only option you have, as there's many different investment products you could choose from to try and mirror the market. Why would someone purchase this, you might ask? And it's actually quite simple. ETFs are known to have minimal fees compared to other products like mutual funds, but I will discuss that more in depth in another video. The main reason, though, to invest in the markets over a single company is that it increases diversification and in turn reduces risk. It also requires little effort and research for the investor, as investing in the overall market means you will move as the market moves. Now you know the basics of the stock market, and I wish your investing journey to be enjoyable and rewarding.